Hey, welcome back. Getting back with the monthly portfolio update with quite a lot to talk about. April was probably the most eventful month and definitely one that will go down in history for a few reasons. I bought a bit of Warner Bros at the beginning of the month, I'll talk about their earnings in a bit, some Verizon and Signify, the LED company that's selling the Philips lighting that most of you probably know. Very quick, WBD is pure value in my opinion, Verizon for the nice 6% dividend plus a bit of defense in the US, and Signify is getting very interesting. The dividend got to 8% now and they also have a pretty significant buyback program starting this year. There is a risk from China, but they have good financials and the price to the cash flow they expect this year is like 5. I think the risk reward justifies buying some more for me. Overall, I feel like even with the market falling, there isn't really some screaming buy right now, but I see a good direction, especially in commodities like oil. I got a decent amount of dividends and a lot more should come in May, which is supposed to be the best month for my portfolio's dividends. I didn't really target equal monthly dividends because I think that's not an efficient thing to do. You know, when you focus on that, you have to give up on value or quality or whatever, and I don't think it's necessary even when you live off of dividends. From MPW's earnings that they reported in May, we saw a nice increase in cash and equivalents, equity remained pretty similar and overall not a bad quarter. I think it's been ages since I've seen such a peaceful report from MPW, although it fell during the earnings conference. Everything advanced, I'd say, in a good direction, and they finished issuing the $2.5 billion in notes, which were even oversubscribed, meaning that the market really wanted them. That covers 2 years of debt, meaning that if they upset 2027 in the next couple of years, that could be enough to see them stabilize. But they said the NFFO should take a 2 cent per share hit in Q2 and going forward due to the higher interest, meaning about 14% of the NFFO in Q1. However, that's with much lower rent collected due to the steward assets transitioning, so that should also improve by the end of 2026 as they expect. But again, even if they make 400 million per year in AFFO, which won't be the case when they start collecting full rent, we are still looking at a nice ratio and very high potential dividend. I actually used to call this the bad scenario in my valuations, but right now it's only temporary and not accounting for a good chunk of their assets. So I think it's just the market overreacting and being cautious again, but it wasn't a bad update overall. Intel also reported earnings and it wasn't that bad, but they also announced firing quite a lot of people. The stock fell because they also mentioned uncertainty due to the environment, which is reflected in the outlook. By the way, the new CEO said even before becoming the CEO that there is a lot of cleanup even in the top management to do in the company. What I want to mention here is that what he has to do is not easy. Sure, a fundamentally solid company, which is a very big advantage, but a terrible environment with high rates and uncertainty around tariffs, plus basically no ability to issue stock to develop because it's so cheap. So he has to do some cuts and try to work it out from what he has with limited external capital. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. We also saw some news about Intel and TSMC reaching a preliminary deal to form a joint venture where TSMC would operate Intel's fabs. That turned out to be fake when TSMC denied even being in talks with Intel, and I'm really wondering if this isn't market manipulation, which is illegal by the way if you aren't a politician. But I can't deny that this is a possibility and someone like Nvidia or even AMD could easily buy some of Intel's fabs and not rely that much on TSMC. I think the most likely or rather optimal thing is seeing a spin-off, which can be very beneficial for Intel while they keep a majority of the company. That way they basically dodge the issues with the stock and debt that I mentioned and also get funding to develop the fabs. That company would then be a strategic asset with high geopolitical importance. And it's also starting to become profitable on an operating level, so it's even better. But again, it's not guaranteed, so there is risk to not see any of this happen and Intel just eventually being bought for scraps. I took a bit of a hit when Nokia and especially Flow Traders, two of my largest positions, crashed on the same day due to earnings, despite nothing terrible and overall good reports. For flow traders, I think the announcement of the CEO retiring was the main factor, while for Nokia it was more about the short-term outlook. They said tariffs should obviously affect them and especially the demand, but the full-year outlook is the same for now. They also generated about 0.7 billion euros in cash flow, which is definitely not bad on a 20-something billion market cap. Again, a quarter is not really that important, but looking at the bigger picture, I think the previous CEO did quite a very good job overall, especially in such an environment. I don't really have that much more to say about Nokia, it's the same company for me and definitely something I'm happy to hold. It's by far not the most profitable investment, especially after this crash, but with the dividends it's actually not that bad, but keep in mind that no catalyst really happened yet. Following the tariffs, the S&P fell by more than 10% in 2 days. As a note, this only happened 5 times in history. Back in 29 with the Great Depression, the Black Monday in 87, one in 2009, March 2020 due to COVID, and now in April. But by the end of the month, we already saw a full 180 on the tariffs, with Trump saying he might lower them significantly and look into working together with the country, not against it, for now. We began the month with massive crashes, fake news that turned out to be real news, then the S&P up 9% after crashing much more, and all this stuff I think is perfectly described by the words clown show. But this could significantly deteriorate the market's trust in the US. It's not even the tariff stuff, but all the amateurishness with the leaks and JD Vance in general, who by the way in the 2016 election was very much against Trump, and Musk in politics and all this stuff. It's not about Trump being right-wing, but the people around him are surprisingly bad. Anyway, from a ratio of 25 or the average of 19 or whatever, the S&P could get to 22 and 16 or something, let's say, which is a significant hit to our long-term results. Suddenly, from that 7-8% expected compound annual growth rate, we could see 4-5% maybe, which doesn't look like a lot, but it's extremely worse in the long term. You know, in just 10 years, it's almost half the variance. And don't think only about your pension portfolio performing worse, but that money can go into things like real estate, for example, meaning you have more expensive houses, higher mortgages, and it can drip into the whole economy. I don't think it would be permanent, but it can take ages to see it recover. Another thing that we saw as a result were US treasuries getting to higher yields, making stocks less attractive. Now, could the US be going into a debt repayment cycle? You know, cutting government jobs, adding tariffs and other things to settle the debt, which Trump talked about. My country had a period like this back in communism and it was terrible for the people. Basically selling everything we made to offset the debt and survive on the bare minimum, although that's always been the same for us back in communism. How would it go for the US? It's very early to assume because we don't even know if the tariffs are permanent or just a way to get leverage in negotiations. Something very interesting is gold reaching new all-time highs, and I made an in-depth video that took over 150 hours of work I think, so please make sure to watch it. I think it's a very good lesson and this is a natural response to this extremely unpredictable environment with war, trade wars, rate cuts, tariffs and so on. And the thing about gold is that given the nature of the commodity and the sources of demand, it can literally go up to almost unlimited levels. It's not like flour where you can double the price of bread overnight, for example. You know, investing is a major source of demand for it, and if it keeps going up, it can lead to fear of missing out or other phenomenon which can be very good for the demand. And even now, after stocks even more than doubled from 2 years ago, I see that everyone is calling it a strong buy, and I see banks putting 4,000 per ounce as a target for this year, which is again normal and part of that fear of missing out and hype. Simply put, do you think the market that bought into all the AI hype and every bubble before wouldn't buy gold if it jumps to 4,000 tomorrow? It's more of a reactionary market than value investing or something. And no, I think it was a strong buy like 7-8 years ago and a good one maybe a year ago, but now we are getting into hype territory. Also, we saw the VIX getting to some of the highest levels in history and then falling as it normally does. This is the volatility index, and I don't want to promote it or anything because it's very volatile and it can get you into ultimately gambling with it. But it's a very good indicator of the sentiment that's going on in the market, and right now we are basically getting into what we saw in 2020 or 2008 or the dot-com bubble. Again, it's very volatile, and even if you think you know what you are doing, it can literally wipe you out if you aren't careful. Then another result was oil crashing quite a bit. That's very easy to explain. Tariffs plus worries for a potential recession mean lower economic activity in the short term, so less demand for oil. I don't think oil stocks are a buy yet, but if things continue or even if the prices just remain at this level, we might see much better prices. Keep in mind that even the best companies have issues when oil gets to like 55 or 50, so if it falls below that, we might see some really serious issues. I mentioned more in the recent Axis stock analysis, by the way. But again, in all this fear and uncertainty, we could also eventually find some opportunities. Now, in other updates, we saw China announce a 1nm chip without using extreme UV lithography and somehow even made it extremely efficient. This is a risk to always remember in tech, especially with monopolies like the one that ASML has. Sure, it can take from months to ages to see it happen on a commercial scale, but it can be the foundation of significant issues for ASML if it is that efficient. And this is why I said before when looking into ASML that paying so much, which implies incredible amounts of growth in a nearly perfect environment just to get to a fair value, is very risky. And even without that, trade wars by themselves can have a very negative effect. AMD even anticipated a hit of like 800 million following the tariffs, so it can really affect the industry. But on the other hand, we saw talks of a potential deal between China and the EU. Again, I don't think this tariff stuff is permanent, but if it is, we might see countries cooperating and developing together while cutting the US from the table. But even after this show is over, it might make countries realize that depending on the US is no longer reliable, which can again lead to that drop in ratios and stuff that I mentioned. You know, it's a gamble from Trump and there is a chance it doesn't pay out. So overall quite an eventful month topped with earnings at the end that will continue in May. If it wasn't for a few bad responses to reports, I think the portfolio would have been basically flat for the month, which is not bad in my opinion. And I guess it's very interesting to see how the S&P fell by a historic amount and then recovered as if nothing happened. But things actually happened and oil is down and gold is up due to a lot of uncertainty that's still persisting in the market. So I don't think we've seen the end of it yet. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.